All right, let's dive deep today. We're tackling a pretty big topic, tax planning, specifically in India using the Income Tax Act of 1961.
The one and only.
We've got tons of source material here. We're talking definitions, the difference between planning and avoidance.
And evasion.
Right, and evasion, of course. Why this all matters for people, for businesses, the whole picture.
We're going deep, not just skimming the surface.
Right.
Getting into that nitty-gritty to really give everyone listening a strong grasp of what's what.
So first things first, got to define our terms. When we say tax planning, what exactly are we talking about?
Well, our sources define it as, it's this systematic analysis of your finances. But the catch is, it's always from that tax perspective.
Right, right. So not just budgeting or investing in general. It's about being tax smart from the get-go.
Exactly. And it's forward-looking. Not about what's already happened, but planning for what's coming. And always, always working within those legal boundaries.
Okay, playing by the rules. So it's about making those decisions, about investments, expenses, timing those transactions, all with the goal of, paying the least amount of tax legally possible.
Minimizing that liability, that's the aim. Taking advantage of every allowance, deduction, exemption, everything the law allows.
So this leads us to a big distinction. Our sources are super clear about this. Tax planning, tax avoidance, tax evasion. Three different beasts.
Absolutely different. And understanding those differences, that's crucial.
Can you break it down for us? Side-by-side comparison, what do you say?
Sure. Let's take, for example, legality, the big one.
Yeah.
Tax planning. Totally legal, by the book. Avoidance. Now, that's where things get tricky.
Yeah, it's like that gray area, right?
Right on. Might technically be legal, but
Yeah.
it uses loopholes, ambiguities, things that maybe go against the spirit of the law, even if it's not outright breaking it.
So planning is playing by the rules, avoidance is kind of bending them, and evasion is, shattering them all together.
That's it. It's breaking the law. Straight up. Hiding income, faking documents, that kind of stuff. Big no-no.
Huge difference in consequences, too, I'd imagine.
You bet. Planning, done right, just means lower taxes, no worries. But avoidance. Even if you're technically following the letter of the law, the tax authorities might come knocking.
Scrutiny, audits, all that fun stuff.
Yeah, they can challenge it. And if they win, reassessments, penalties, interest charges. Not pretty. Plus, the law can change. They close those loopholes, sometimes even retroactively. Suddenly, what you thought was clever avoidance becomes a big problem.
And evasion, that's just straight up trouble.
Big time. Huge fines, interest on that unpaid tax. You could even face criminal charges. Jail time, in some cases. Not worth it.
So it really boils down to intent, doesn't it? What are you trying to achieve?
Exactly. Planning. You're using those deductions, exemptions, all the tools the law gives you to legally lower your tax burden. Avoidance. It's more about exploiting those gaps, even if they weren't intended.
Kind of playing a risky game, huh?
It is. And with evasion, the intent is just to avoid paying, period. No pretense of legality there.
So planning is ethical, responsible. Avoidance, it's in that morally gray area. And evasion, straight up wrong, both legally and ethically.
Couldn't have put it better myself. Our sources are clear. Tax planning is the way to go. Do it right, stay informed, and there's no need to get fancy with questionable schemes.
Now, why is tax planning so important? We've got individual benefits and benefits for businesses. Let's start with individuals. How does good tax planning actually affect someone's finances?
Well, for individuals, it's a game changer. Think more money in your pocket. That's the immediate impact, right? Less tax means more disposable income.
That makes sense.
And then that extra money can go towards things that matter. Savings, investments, whatever your goals are.
Retirement, a house, kids' education.
All of that. And there are so many tax-advantaged investment options out there. Things that can help you build wealth over time.
Like those under Section 80C.
Yeah, like those. You get the tax deduction now, and you're investing for the future. It's a win-win.
Those savings add up.
They really do. It's not just about the immediate benefit either. Good tax planning can have this ripple effect on your whole financial life. You're managing your cash flow better because you know what your tax obligations are throughout the year. You're not hit with a huge bill at the last minute.
Right. No surprises.
Exactly. And that peace of mind, that's priceless.
All right. So individuals benefit big time. But what about businesses? How does this play into their success?
For businesses, tax planning is just as important, maybe even more so. We're talking about their bottom line here, their profitability. Less tax expense means higher profit after tax.
Straightforward impact.
Yeah, it's direct. And that extra profit, they could reinvest it, distribute it to shareholders, lots of options.
Fueling that growth.
Exactly. Then there's cash flow. Those tax savings free up cash that could be used for all sorts of things. Working capital, expansion projects, paying off debt.
Keeping the wheels turning.
Right. And get this? Good tax planning can even give a business a competitive advantage.
That's
Well, if their tax costs are lower, they can be more competitive with their pricing. Or maybe they can invest more in R&D, things that give them an edge.
smart.
Plus, the government has all these tax incentives for things like SEZs or R&D. Taking advantage of those can make expansion and growth much easier.
Makes those ventures more attractive, financially speaking.
Exactly. And of course, we can't forget about compliance. This is huge. Good tax planning means you're following the rules, minimizing the risk of litigation, penalties, all that headache.
Staying on the right side of the tax man sounds like a good plan to me.
It is. So for businesses, tax planning isn't just a financial strategy, it's strategic in every sense. It's about survival, growth, success.
All right, let's get specific. What are the main objectives someone's trying to achieve with good tax planning? What are they aiming for?
Our sources break it down into a few key objectives. First and foremost, reducing that tax liability. That's the big one, right? Paying less tax legally by using every available provision, deduction, all that.
The bread and butter of tax planning.
Exactly. But there's more. Minimizing litigation is huge.
Avoiding those legal battles, right?
You got it. If you're compliant, your records are clear, and your finances are structured properly, the chances of a dispute with the tax authorities go way down. No penalties, no interest charges, no lawyers' fees.
Saves a lot of stress and money.
Tons. Then you've got the idea of productive investment. Tax planning often involves taking that taxable income and putting it into savings or investment schemes that give you tax benefits.
Like those Section 80C investments again.
Yeah, exactly. Things like PPF, ELSS. You're saving on tax and you're building your wealth for the future.
Double benefit.
Right. And think about the bigger picture. All that saving and investing, that contributes to the overall economy.
Healthy growth, right?
Exactly. So like a virtuous cycle. And finally, good tax planning, as part of good financial planning, leads to economic stability. Less financial stress from tax obligations, better money management. It all helps individuals and businesses, and ultimately the whole economy, be more resilient.
So it's not just about the numbers, it's about creating a more stable foundation.
Absolutely.
All right, let's talk about the big kahuna, the Income Tax Act of 1961. What's its purpose, its scope, the basics.
Well, the Income Tax Act, as our sources put it, it's the backbone of income tax in India. It's the law of the land when it comes to taxes.
The ultimate authority.
Right. It lays down the rules for everything, how income tax is levied, administered, collected, recovered, the whole 9 yards.
So it covers everyone who earns income in India.
Yep, the whole country. It's comprehensive, detailed, complex.
Not exactly light reading.
Not at all. It's got sections, subsections, clauses, explanations, you name it.
Yeah.
Plus, there are schedules with extra info in the income tax rules of 1962, which go even deeper into the procedures.
Layers upon layers.
Exactly. And here's the thing, it's not static.
Yeah.
It changes. It evolves.
Dynamic, right? Our sources make a big deal about that.
And for good reason.
Yeah.
It's amended every year through the Finance Act, which is part of the union budget.
Keeping up with the times.
Yeah, and government policies, economic conditions, all of that. Sometimes they simplify things, sometimes they close loopholes, sometimes they add incentives. It's a living document, always adapting.
So staying up to date is key.
Absolutely crucial. For anyone involved in tax planning, knowing those amendments, the latest court rulings, all of that, it's essential.
All right, let's zoom in on some of the key provisions, the sections that are really foundational to understanding income tax. Where do we start?
Well, we got to start with the source of the government's power to tax in the first place. That's Section 4, often called the charging section.
Charging section sounds important.
It is. It's the legal basis for the government to levy income tax on everyone's total income. It sets the stage, basically.
So that's the foundation. What about the definitions? There must be tons of specific terms used in the Act.
Oh, there are. And understanding them is crucial. That's where Section 2 comes in, the definition section. It's like the glossary of the Income Tax Act.
So important.
It is. It defines everything from person to assessment year, previous year, and of course, income itself. Plus, it explains those key concepts, gross total income, all that. Without Section 2, you'd be lost.
Like trying to read a book in a foreign language.
Exactly.
What's next in our essential sections rundown?
Well, in today's world, with people moving around so much, Section 6 is crucial. It's about residential status.
Ah, so where you live matters for tax purposes.
Big time. It determines whether you're a resident and ordinarily resident, R or R. resident but not ordinarily resident RNOR, or a non-resident NR in India for that financial year.
So many
I
acronyms.
know, right? But the point is, your residential status affects what income of yours is taxed in India. An RR is generally taxed on their worldwide income, while an NR is usually taxed only on income earned or received in India.
So your connection to India
It's
matters.
a lot. Now let's get to how the Act actually categorizes income. This is where Section 14 comes in. It lays out the 5 heads of income.
5 heads. Okay, like chapters in a book.
Sort of. These are the buckets all income falls into. You've got salaries, income from house property, profits, gains of business or profession, capital gains, and income from other sources.
PGBP, that's a mouthful.
Yeah, it's usually shortened. But the point is, each of these heads has its own set of rules for how you calculate taxable income and what deductions you can claim.
So it's not one size fits all.
Not at all. Each head is unique. Let's go through them one by one, get a sense of what they cover.
Sounds good. Let's start with salaries. Pretty self-explanatory, I'd say.
It is, in a way, it's all the income you get as an employee from your employer. So basic salary, allowances like HRA, DA, perquisites, retirement benefits, it's all in there.
And the specific rules for salary income are in.
Sections 15 to 17 of the Act. Those are your go-to sections for all things salary.
Got it. What about income from owning property? Where does that fit in?
That's income from house property, the second head. This one's all about the income you get from owning real estate. Mostly rent, but even if you live in your own property, there's this concept of notional rent, which can come into play for tax purposes.
Interesting. So even if you're not receiving rent, you might still have taxable income.
Sometimes, yeah.
Yeah.
And the rules for calculating that income, plus all the allowable deductions, you'll find them in sections 22 to 27 of the Act.
Like the standard deduction, municipal taxes, the interest on a home loan.
All those are in there.
All right, next up, profits and gains of business or profession. PGBP, the shorter version.
Right. This one's for anyone running a business or practicing a profession. It's the income you earn from those activities.
So doctors, lawyers, shopkeepers, entrepreneurs.
All of them. And the way you calculate the taxable income here is by taking your total revenue and subtracting all the expenses you incurred to run that business or profession.
Makes sense.
Now, figuring out which expenses are allowable, that can get tricky. That's where sections 28 to 44 DB come in. They cover everything from stock valuation to depreciation, plus specific rules for different types of businesses. It's a dense area.
Sounds like it. Okay, then we have capital gains. This is about profits from selling assets, right?
Exactly. Things like property, shares, gold, those are all capital assets. And the key here is the difference between short-term and long-term capital gains. STCG, LTCG.
More acronyms.
I know. But it's an important distinction. It all depends on how long you held the asset before selling it.
Right. Short term means you held it for a shorter period. Long term means longer. And they're taxed differently.
Yep. And the holding period that makes the difference, that depends on the type of asset. For shares, it's usually more than 12 months for long term. For property, it's usually more than 24 months.
And all the rules for calculating those gains, plus things like indexation for long-term assets, that's all in sections 45 to 55A.
That's the place to look.
All right, last but not least, income from other sources. The catch-all category, right?
That's the one. It's for any income that doesn't fit neatly into the other 4 heads. So interest from savings, dividends, lottery winnings, gifts you get above a certain limit. It's a mixed bag.
The odds and ends of income?
We could say that. And sections 56 to 59 are where you'll find the rules for IFOs.
All right, so we've calculated our income under all 5 heads. What's the next step in figuring out our total taxable income?
Good question. Now we're getting to gross total income, GTI.
GTI. Okay, what's that all about?
It's basically the sum of all the income you've calculated under each head. But there are a couple of things to remember. First, there are rules about clubbing of income. Sometimes income from family members like your spouse or kids can be added to yours.
Adding it all up.
Right. And then there's the set-off of losses. If you have a loss under one head, you might be able to offset it against income from another head.
Balancing things out.
Exactly. And the key thing to remember is that GPI is your income before any deductions under Chapter VIA.
Right, before those big deductions. So GTI is kind of like an intermediate step.
That's a good way to put it. It's not the final number, but it's important.
Okay, so how do we then get to the income that's actually taxed, the total income?
That's where those Chapter VIA deductions come in. You take your GTI and you subtract all the deductions you're eligible for under sections 80C to 80U, and voila, you have your total income.
TI, the final number.
That's it.
Yeah.
And that's the figure that's used to calculate your tax liability.
Makes sense. So understanding those Chapter VIA deductions, that's crucial for tax planning.
Absolutely crucial. Those deductions can make a huge difference in how much tax you ultimately pay.
All right, final piece of the puzzle. Tax rates and surcharge. This is what determines how much you actually pay, right?
Exactly. And the most important thing to remember here is that tax rates aren't set in stone. They change every year.
They're in the Finance Act, right? Not in the main Income Tax Act itself.
That's right. So the rates you're paying this year might be different next year. It all depends on the Finance Act that's passed for each assessment year.
Always got to check the latest version.
Always. And for individuals and HUFs, the system is progressive,
Progressive meaning?
meaning the more you earn, the higher the rate you pay. There are different income slabs, each with its own rate. As your income goes up and crosses into a higher slab, the portion in that higher slab is taxed at a higher rate.
So it's like a sliding scale.
Yeah, you could say that. And it's not just individuals and HUFs. Companies, firms, everyone has their own tax rate structure.
Different rules for different players.
Right. And we have the choice between the old tax regime and the new tax regime.
Two different paths.
Exactly. The old regime has more exemptions and deductions, but generally higher tax rates. The new regime, under Section 115 BAC, has lower rates, but you give up most of those exemptions and deductions.
Trade-offs, trade-offs.
Always. And don't forget about special rates for certain types of income. Things like long-term capital gains from shares, short-term gains, lottery winnings. Those often have flat rates, regardless of your income slab.
So it's not as simple as just looking at one tax rate chart. It's more nuanced than that.
Way more nuanced. That's why checking the specific Finance Act for the relative year is so important.
Can't stress that enough. All right, now let's talk surcharge. What is it and who does it apply to?
Surcharge is like an extra tax on top of your regular income tax. It's calculated as a percentage of the income tax you owe, not on your total income.
A tax on your tax. Ouch.
It can feel that way. But it only kicks in when your income crosses certain thresholds.
Thresholds meaning?
Meaning if your total income is above a certain amount, then you start paying surcharge.
And those amounts are different for different people.
Yep. Individuals, HUFs, companies, firms, they all have different thresholds and rates. And usually the higher your income, the higher the surcharge rate.
So it's primarily aimed at higher earners.
That's the idea. For individuals, for example, it might start at, say, 50 lakh rupees of income. Then a higher rate kicks in at 1 crore, then another at 2 crores, and so on. But again, the exact numbers, the thresholds and rates, they're all spelled out in the Finance Act.
Got to check the fine print.
Always.
Now, our sources mentioned something about a cap on surcharge for dividends and certain capital gains. Can you explain that?
Yeah, that's an important point. For individuals, HUFs, AOPs, BOIs, the surcharge on income from dividends and certain capital gains, like those from selling shares, that surcharge is often capped at 15%.
Even if their total income is much higher.
Even then. So it's a bit of a relief for those folks. But again, got to check the conditions and rates in the Finance Act because they can change.
The Finance Act, it's the Bible of tax planning.
Pretty much. All right, last concept I think we need to cover is marginal relief. Sounds like a bit of a safety net.
What is it exactly?
It's basically a rule to make things fairer when your income just barely crosses one of those surcharge thresholds. It prevents a weird situation where earning a tiny bit more actually results in you paying a whole lot more in tax because of the surcharge.
That wouldn't be very fair.
Nope. So marginal relief limits the total tax you pay, making sure that the extra tax you owe because you cross the threshold isn't more than the extra income you earned.
Makes sense.
So let's say the surcharge kicks in at 1 crore rupees. If you earn 1 crore and 1 rupee without marginal relief, you might end up paying way more tax than that extra rupee you earned.
That's what it's there to prevent.
Exactly. Smooth things out, keeps it fair.
All right, well, I think we've covered just about everything. This has been a deep dive and a half. We've gone from the very basics of what tax planning is, all the way to the complex stuff like surcharge and marginal relief.
Yeah, we really went in depth. We talked about the difference between planning, avoidance, and evasion, the importance of tax planning for individuals and businesses, the structure of the Income Tax Act, all those key sections, the fact that it changes every year, and then all those definitions, heads of income, GTI, TI, tax rate, surcharge.
It's a lot to digest, but it's so crucial for anyone who wants to manage their finances well, make smart decisions, and stay on the right side of the law.
Couldn't agree more.
So, as we wrap up, here's something to think about. Given how complex the Indian tax system is and how it changes all the time, what are the best ways for people and businesses to stay informed? How can they make sure they're incorporating good tax planning into their overall financial strategies?
That's the million-dollar question, or maybe more like the multi-crore rupee question.
Hmm.
It's something everyone needs to consider because doing it right can make a huge difference in your financial well-being, both now and in the long run.
All right, folks, thanks for joining us on this deep dive. Hope you learned a thing or two, or maybe 100.
And remember, stay informed, stay proactive, and plan smart.
Until next time.